Okay, in this tutorial, I'll go through with you the GII symbol, and I will just copy that and paste that in Google and write stock beside it. And this is the name of the stock. And if I want to buy the stock right now, I have to pay 28.51 US dollars per stock. And I can see the market cap is in billions, which means it's a big firm. It doesn't pay out any dividend yield. Companies that pay out dividend yield, it shows that they have very good financial position because they're able to pay their creditors, their loans, their debt, and everything, but still they have money left that they pay out as dividends. But this firm don't pay any dividends. It doesn't mean that they are financially weak, but some firms are doing very good, but they decide not to pay the dividend. So this is just one factor to look at it. Then I can see when was this founded in 1956. If I just go to Wikipedia and I just go to the box and I can say founded 1956 and I'll just copy that and I want to see what the employees think about it. I'll go to Indeed and I can see 11 reviews, which is not plenty, and it's 4.2 star, which is brilliant. And if I just go in Glassdoor and I'll click that, and there are 139 reviews and it's 2.3 star, which is below average, but there are 140 reviews and you can just go through yourself what the employees have to say about it. Then just go to Justia Patents. This is a website that has patents shown. I've left the link in the search bar, so it's up to you, and if you have any questions, please ask. I'll be happy to answer. And I'm just interested, I'm not interested in inventor. I'm interested in applicant or assignee because these are people who have the full rights of the patent. So it has patents in 2012, 2016, 2014, 2014. So the recent one they have in is 2016. They don't have any in 17, 18, 19, but they have in 16. So make sure that the more patents they have, better moat they have. It's more competitive and they can survive in competition. So the more patents they have, the better, the stronger the firm, and make sure they have recent patent as well. And now I want to look at the key executives. Now I will go to Yahoo Finance and I will just click on it and go to profile. Go to sector, industry. You can look at the sector, the industry is apparel, manufacturing, the full-time employees, and you can see that there are 5 executives, the title and the salary. All of the executive salaries has been shown, which is brilliant because this means that there's a lot of information we have about the company. It's very transparent. The more transparency, the more better, the more trustable it is. It has all the salaries shown, which is brilliant. And now I want to go to macro trend. I've left the link and please ask me any questions you want. Click price ratio and price book ratio and I'll just paste in the symbol actually instead of the name, and I'll click that and I'll explain you briefly what price book ratio is. It takes time to load things on this because it's a lot of information, so it's usually, it takes time to load, so you have to be patient with it. Okay, so book value is the real worth of the stock, and stock price is the market price. So the book value is, if for example, one and the stock price is two, that means you're paying $2 to buy something that is $1 worth. If the price to book value ratio is less than one, that means the stock is at discount, it's cheap, it's undervalued, and it's best time to buy. If it's one, that means that it's the same as the market price and you're not buying an expensive stock, so which is brilliant. So you're buying it for the real price. If it's more than one, it means you're buying an expensive stock. Higher the number goes, the more expensive it gets. Right now it's 1.18 times more expensive. So you're paying 1.18 times more money. In 2015, it was most expensive because it was four times. People who bought that time paid four times more money to buy that stock. If you see vertically up, you can see that people who bought that time in 2015 July, they paid $72 to buy something that was only $17 worth. So it was very expensive. But right now it's expensive. It's a little bit more expensive, but it's 1.18 times more expensive. So it's much cheaper than in 2015. So you need to be careful about that. Then you just go to other ratios, you check the current ratio. In current ratio, if the ratio is less than 1, that means that um, the stock is very risky to buy, it's not safe. If it's 1.5 or more than that, that means stock is very secure, it's not risky, there's a lot of margin of safety, and you must buy that time. So look for ratio of 1.5 or more than that. So we are looking at 1.5 or more than that for current ratio. Right now it's a lot more than 1.5, which is brilliant. Let's look at the previous ones. Okay, so up till 2010 it's brilliant, and then 2009 it's a little bit less than 1.5. So for 3 months from July to September, it's a little bit less than 1.5. So I won't be very strict on that because it's just 3 months and it's not a lot less than 1.5. And then it has been like for 3 months in 2008 as well, it has been less than 1.5, and so on. So since we have data 2005 up till now, 14 years, it has been like for 6 months less than 1.5, but not very less, so few points. So I would say that it has been very good, very secure, very good margin of safety. So it has always been above 1.5, which is what we're looking for. Let's look at debt equity ratio. Debt equity ratio tells us that if the company is mainly operating on debt or equity, we are looking for ratio zero point 0.5 or less than that. So right now we have 0.59, it's a little bit above zero point 0.5, which means it's a little bit risky. But let's look at the previous ones. It's zero point 0.3, which is brilliant, and then it's 0.59, again risky, then brilliant, less than zero point 0.5. So it has its fluctuations, I would say, and its recent fluctuations, and then it has. So if we just have a look, that we have data since 2005. Since 2005 it has been below zero point 0.5, what we are looking at, zero point 0.5, and only in 2017 July it became above zero point 0.5. And so up till 2017 it was not risky, it was very safe. From 2017 July it has been become risky stock because it has been above zero point 0.5, so it's fluctuating. So let's look at return on equity. So we are looking at return of 8% or more than that for it to be ideal. But let's have a look. So we can see it's more than 8%. Let's look at the previous ones. So there are fluctuations. So in 2017, 2000 whole of 2017, it is below 8%, but still it's a positive one. So let's have a look. So it is above 8%. And then so after 2010 January, it has always been above 8%, which is what we are looking at. So it has been above 8%, but in 2018 17, whole of 2017, full year, 1 year, it has been below 8%, but still a positive one. And now again it's above 8%. So just 1 year it has been below the point, but otherwise it has been consistently above 8%, so which is brilliant.